Stocks are currently seeing a rejection, but the S&P 500 might be predicting another decade of economic prosperity. Let's get right to it and I'll show you. Hello everybody and welcome. My name is Tim from the Camp Compound and it's time for our stock analysis. We have just started with this, so let's get right to it. I have something interesting to show you. Here in front of us we have the S&P 500 on the 1 month chart, and we talked about this in our community a couple of days ago, but what we see here is a chart going all the way back to 1872, and what we see here is two very clear cycles. Here we have a 10-year kind of an economic stagnation, and stagnation in economic case is backwardation, meaning that they were really tough times, which makes sense. They were around the 30s, which are not exactly known for their prosperity. Now, then we had about a 27-year move upwards, as we can see. This is, by the way, a 100 simple moving average. And then when that was broken, we entered another 10 years of relative economic pain. That is around the 70s, which some of us may still remember as quite a rough time economically, where inflation was also very high. Then, when we broke back above, tested as a support, we moved into another about 27-year time of prosperity, followed after the dot-com crash by another 10 years of fairly economic rough times. And now that we are back above, we have only had 10 years of relative prosperity, and we see that right now we are in a downtrend. Now, so the key thing here is that we may still have another 10 to 20 years of economic prosperity before the real recession for a longer period starts. Of course, the past, let's say, year or so has not been great, but it is still a far cry from these 10-year periods, and we may still see a couple of economic stimulus cycles before anything really starts to break, if we can follow this S&P 500 chart. Meaning that, let's say in 2023 or 2033 to maybe the end 30s would really be when we have to be on the lookout and have to prepare for. So that is what I want to start this new series about stocks with, so that we have kind of an idea or for the next decade what we have to look for. So really we want to make sure that we don't cross under this 100 simple moving average. Having said that, let's move into the nitty-gritty of it, because right here we have the S&P 500 on the daily, and here we see that the S&P 500 was rejected again from its downward trend line. So this started at the end of 2021. We've had 1, 2, 3, 4 rejections, technically 5, I guess you could say, and this is now the fifth or sixth one. And what we see here is a very clear rejection, then a gap down already, which may signal that we get a fill soon up, so a bit of a retrace, possibly again towards that trend line. And what we see here is also an upward trend line from this bottom, meaning that we may just move a little bit lower before trying again. So this is really the main trend that we want to break, and then we want to break above this 400 points to make sure that we can also set a new higher high, which is of course what we need in order to really set a new uptrend. Higher highs and higher lows. Otherwise we're just in price consolidation, which means that we could still crash all the way back down. So that is it in the SPY. The SPY is a bit stronger than the Nasdaq at the moment. As we can see right here, it has not really managed to reach its downtrend. As we can see here, this is also a bit more of a messy chart because we are in this support zone right here, and there is a bit of a bearish undertone to the current price movements. So it could definitely be that we see another move down towards here, that 235. These are trust series, not the markets themselves, so that is why the numbers are a bit different. And then for the Nasdaq, we actually want to see a break here of the 330 in this case, or actually a bit higher, that 335, so that we can properly break through and try for new all-time highs. But of course, the Nasdaq is riskier. People are not as inclined for risk at the moment, especially with rates as high as they are, condenses the price-earnings ratio, which then makes tech stocks less attractive. So that is the long and the short of it. There are a couple stocks that we are currently in. Basically, our ING short was perfectly timed. We stopped in, or we started right here, and now we are currently trying to break through this support right here. We gapped under it, are now trying to retest it, but we may just see a deeper retrace probably towards here. You see that there is a very clear level around that 12. This is in dollars probably, yeah, in $12.4. JP Morgan also making that double top, as you can see here. Is it also a bearish divergence? Let's see. We have definitely a bearish divergence here. Didn't really take too well, but then if you take it across this high here, you have 70, and here you have 73. So there is no proper divergence, as I can tell. Oh, well, actually this is 74.4 and this is 73.85. So there is definitely somewhat of a divergence, something to keep in mind. JPM generally a good stock for scaling in. That could be here around the 122 and possibly here around the 111. Something to look at. It's somewhat shortable around here if it shows the right price action around that 150, but we'll see at that point. Tesla making a bit of a bounce in line with the Nasdaq. Actually, I want to see what this looks like on the weekly chart. And what we see here is a clear move down. Bit of a retrace. It is a bit sharper than I would like, because if it is in that 45-degree angle, then we could say that there is a good chance for breaking down lower. But this is a bit too sharp, meaning that we might just see a correction back down to the support and then moving back up. I know I could get my pathing tool for this, but I was already going, so oh well. So that is kind of what we could see for Tesla. There's this support area which is decently strong. Truly the last proper support until we can go farther down to that $60 approximately. Crowd we're also looking at, it is at a very nice support currently. Decent for scaling in. So this weekly candle is not looking too hot, but if we look at the daily, we see that there is some definite support that we could use. So now we are just waiting for a bit more confluence, and then maybe somewhere in this range right here we could enter between that 94 and 98 to 99. Otherwise we would have to wait quite a bit further, maybe here towards that 80. That is kind of what we're seeing in Crowd or CrowdStrike. Here's Amazon as well. It's kind of a similar market, especially stuck between this range of the 80 to the 101 or 102 approximately. Could be interesting if it gets a bit lower, but that would be a double tap here of this support, which could be interesting. Don't forget that it's also almost earnings season, in which stocks generally get pretty violent and volatile. So keep that in mind. That generally is a good time to trade, but we will have to check first what the general sentiment is and how the economy performed. And then we have SDS, which we are also in and currently doing fairly decently, showing that nice uptrend right there. That's it for the stock market at the moment. Hopefully you found this useful, and if you're curious or have any questions, of course feel free to drop by in the community and ask any and all questions that you have. Moral of the story is keep calm, keep cool, keep compounding. I'll see you in the next one. Bye bye.